Hey, hello everybody. I'm just here to help get you some help with your homework and try to work a few problems so that you'll start to get the material. I hope that eventually, once you go over the problems and you look at some of this information that we have, that it'll start to make sense to you. I have here short exercise 2-3. I'm just going to try to go through it as a review. Here we have to tell whether each of the following accounts is an asset, a liability, a revenue, an expense, or none of these. So the first one on here says accounts payable. Remember, I told you whenever you see payable, payable means liability. So it is something that we owe. So accounts payable is a liability. And where does the liability go? It goes on the balance sheet. Supplies. Supplies is an asset. Where do supplies go? It goes on the balance sheet because it is an asset. Now withdrawals. Remember I told you withdrawals is when a owner may take money out of the company and put it in their own personal account. Withdrawal affects equity. If you look at this asset, expense, liability, revenue, withdrawal is none of these. Fees earned, for fees earned, that's just like revenue. Where does revenue go? Revenue goes on the income statement. Supply expense, it already gave it to you here. The key word is expense. So this is an expense. Accounts receivable. Accounts receivable is different than an accounts payable. With an accounts payable, we owe somebody money. So we may have gotten a product or we may have gotten a service done, and we tell them, hey, we'll pay you within 30 days. So we owe them that money. With an accounts receivable, we're on the other end. Someone owes us money. So we sold a product or we completed a service and they tell us they're gonna pay us at a later date. Accounts receivable is an asset. Unearned revenue, I'm not sure if we talked about this as much, but what do we say with accounting? Revenue is recorded when it is earned. So it is recorded as revenue when it is earned. If it's unearned, that means that we have not officially earned the revenue yet. So, well, one of the examples of that, if I have a newspaper subscription or magazine subscription company, and a person decides to pay me up front, they say, hey, I'm going to subscribe for the next 12 months and it doesn't begin until next month. Well, if they pay me for the next 12 months, I haven't earned that revenue yet. It goes on my books as unearned revenue. So as a result, unearned revenue is a liability because you have the money, but you haven't earned the revenue yet. That's a liability. Equipment, this is an asset. All right, I'm going to move forward to number two. Number two, short exercise 2-04. Here's some more here. Now, this is what we started talking about in class on Monday. This is short exercise 2-4. It says, tell whether the normal balance of each account listed below is a debit or a credit. Okay, so let's look at this first. What do we mean when we say normal balance? What do we mean when we say normal balance? I don't like that red. I'm going to use black. Normal balance, that's what happens to an account as it increases. So there are two things. Remember, I told you in accounting, we have what we call a T account. And with a T account, we call it a T account because it's just a T. And on the left side, we call the left side debit. So I'm just going to say D for debit. We call the right side credit. So that's all it means. So in accounting, We have a left side, which we call debit. We have a right side, which we call credit. When an account, what's an account? We said it represents assets, liabilities, revenues, expenses. When an account is increased, the normal balance is what we do to it. Is either we debit it or we credit it. So when an account is increased, the normal balance is what we do to it. Do we debit it or do we credit it? You might also remember I gave you the analogy of pregnant Alice. I'm going to put that on here again. Pregnant Alice is your friend. Make sure you understand who pregnant Alice is. Okay? So, I'm going to write Alice again. All right. So, if you remember, liabilities, income also means revenue, liabilities, income, and capital. Whenever it is increased, we credit it. That's why everything, you look at Alice, everything over here, when we increase it, it's a credit. When our liabilities increase, we credit it. When income increases, we credit it. When capital increases, we credit it. On the other hand, with assets and expenses, when we increase those, we debit it. So if you remember this, you'll do okay. All right. So let's look over here again. Let's look over here again. All right. So tell whether the normal balance of each account listed below is a debit or a credit. Okay. So accounts payable. What is accounts payable? Accounts payable, keyword payable, is a liability. What happens when we increase a liability? Okay, even if I want to go look at pregnant Alice on the right side over here, oh, it's a credit. So when I increase an accounts payable, when I increase a liability, I credit it. That is the normal balance. And whatever I do when I increase it, that's all we're doing right now. Supplies, what is supplies? Well, we just said supplies is an asset. It's an asset. What do I do when I increase an asset? When I increase an asset, I debit it. Therefore, it is the normal balance for an asset. What do you do when you increase? You debit it. Withdrawals. Now, you will remember in class, I said on Monday, I said there is an exception. And the exception for capital is withdrawal. You will never have a withdrawal that is a credit. Withdrawal will always be a debit. So withdrawal is going to be debit. Fees earned, we mentioned that. What's fees earned? Fees earned is revenue. What happens when I increase revenue? I credit it. Now, you haven't seen this much. Supplies expense, we just mentioned this in the previous exercise, but supplies expense. So with a company, and this is what I want you to think about. With a company, they will buy supplies. When they start to use those supplies, whatever they use becomes supplies expense. And then that's just how I'm going to explain it. We'll talk about that a little bit more in future chapters. But what I want you to understand right now is that this says expense. That's what this says. It says expense. So it's not just supplies. If it says just supplies, it's an asset. But if it says supplies expense, it's an expense. Don't try to make it what it's not. It's an expense. This just means this is the number of supplies that they have used. So supplies expense. What do we do when increasing expense? When pregnant Alice, I go back, look at her. She said we debit it. Okay. Okay. So now I'll let you work on the rest of them, but accounts receivable, you should know what that is. Unearned revenue, you should know what that is. We just talked about that. Equipment, you should know what it is. Whatever, what do we do when we increase it? Do we debit it or do we credit it? That's all you're doing in short exercise 2-4. I'll be back with more.